In this lesson, we're going to be talking about how do we figure out how much life insurance a person actually needs. And as you'll see that there's actually two formulas that you need to use, and you need to know both formulas. One of the formulas is fairly simple, the other one's a little more complicated, but together we can get through it. Once again, I would stress to you, please take out a clean piece of paper or something, write this example down, and that way you can follow along with me because it does get a little bit complicated. The first one is what we call a capitalization of income. Another name that you probably have seen is what they call the human life value. Now, we know that we can't really put in an actual value to human life. However, from an insurance company perspective, what we're really looking for is the economic value of an individual, not so the human life value of it, it's really the economic value of an individual. So therefore, capitalization of income really talks about the economic value. Now, the key word here is the word income. In other words, what we're saying here is we've got a particular client who has an actual income that he generates every single year. And so let's assume that in our example that your client is generating $50,000 worth of income every single year. Now, if this individual should die, that $50,000, of course, is gone. So the whole idea of capitalization of income is to produce a fund of some sort, a pool, you might say, of money that at a certain rate of interest will generate $50,000 worth of income. Okay, so let's assume for a moment, okay, that the $50,000, the pool of money that we could generate, let's say, would generate a 5% return on your money, just keeping it simple. So in other words, we can invest that pool of money into a 5% note of some sort, and so therefore that 5% then will generate $50,000. Now, I want to stress to you here that when we're talking about interest rates, we are talking about real interest rate. And the real interest rate, if you remember, according to the notes that you've got, is your nominal rate, which is really your posted rate, okay, minus inflation. Very important. Minus inflation gives you your real. So whenever we are talking about interest rates, when it comes to insurance purposes, okay, we're talking about real interest rate. And real interest rate is the nominal rate minus the inflation rate. Now, sometimes on the exam, they may actually say this is the real interest rate, in which case you use it. And some other times, they may say the interest rate is 8%. However, inflation is running at 3%, so you now know that 8 minus 3 is 5%. So therefore, let's assume again in our example that it is 5%. So therefore, we say, all right, how much money do we need to have in a pool that will in fact generate $50,000 at a 5% investment vehicle? Well, all we have to do then is simply divide 50,000 by 5%, basically. And it's 0.05, as you probably well know. But anyway, it's 5%. So therefore, what we're saying is that $1 million of insurance at 5% will generate $50,000 worth of income forever and a day. So basically, there's your capitalization of income. We've noticed that when we're talking about capitalization of income, we are only concerned about income. In other words, this individual could have had all sources of other income. They could have had assets of some sort. They could have had rental income. They could have an investment portfolio. The capitalization of income discussion basic formula does not factor any of that stuff in. All they're concerned about is what is the income that will finish or will die off when that client dies. Well, if that individual is making $50,000 a year, that person dies, that $50,000 dies with him. It's as simple as that. So therefore, we have to replace that $50,000. So how do we do that? When we take the $50,000, we have to create a pool. And that pool in our example is really $1 million because 5%, if you multiply 0.05 times 1 million, it'll generate $50,000. So again, remember that we must always use the nominal minus inflation gives you that real interest rate. So it's very important that you remember that. So that is what we call the capitalization of income. And that's a pretty simple one. Really, when you think about it, it's a pretty simple one. Now let's take a look now at a little more complicated type of product, which is called capital retention. Here, we are factoring in everything. In other words, we're factoring absolutely everything that's going on here. So it isn't just the income. We're going to factor in the assets. We're going to factor in investments. We're going to factor all those things in. So there are 4 things that you must do in order to be able to figure out how much insurance a person actually needs, okay? The first one is basically what we look at is if you die today, how much money have you got sitting somewhere that within a short period of time, let's say 30 days, we could actually access to pay off what we call your last expenses. In other words, we have to figure out a last expense, basically. How much money do we actually have in order to actually pay off these last expenses? Well, we say, okay, well, what we've got is I've got, let's say again in our example, in other words, I've got assets. It could be cash, it could be GICs, it could be a host of different things. In other words, money that I could very quickly get my hands on to pay off those last expenses. Those are called assets. And let's say we had $50,000 that we could, in fact, get our hands on. And again, on the exam, they'll give you all this. They'll give you these numbers, okay? Now, the next question is, what are the expenses? In other words, when I die, what are my expenses? In other words, what are the things that I want to get rid of? So again, your client will say, well, I'd like to get rid of my mortgage. Well, how much is that? Well, it's $250,000. I've got a line of credit. How much is that? $50,000. Okay, now we're up to $300,000, and so on and so on and so forth. So let's say that our last expenses, okay, happen to be $450,000. Okay, all in. In other words, what we're trying to do is to leave the survivor with a clean slate. Okay, we want to make sure that this person's spouse, when he dies, she dies, whatever, the spouse gets basically left with a clean slate. In other words, the house mortgage is paid off, line of credit is paid off, everything's paid off. So if you had an opportunity to write a big check to get rid of all this debt, what would it be? Well, it would be $450,000. Okay, well, you've got 50 already sitting in the bank. All right, you need 450, so therefore you have a shortfall of $400,000. So that is insurance number one. In other words, we have to insure you for $400,000 just to take care of your last expenses. So the first insurance need is what we call last expense need. Okay. The next insurance need is what we call income needs. In other words, your family still has to eat. They still have to pay bills. They still have all those things. Okay. In other words, life has to continue on. Yes, you're passed away. It's over with. But you, obviously, leaving a family behind, they have to eat. They have to pay, payments. They've got expenses to pay and everything. So the next thing is we have to look at is what is the continuing income? In other words, how much money will continue to come into the door after you've passed away? In other words, will your spouse continue to work? Yes. And what is your spousal income? It's $50,000. Okay, fair enough. So that will continue on coming in. That's right. We've got rental income of $10,000, and now we've got $60,000 coming in. In other words, what is the income that doesn't stop when you pass away? Okay, what is that continues on? Whatever that income is, so let's assume that in our example, it was in fact $60,000 of income that's coming in. Okay, so now we have to say, all right, that's how much money continues to come in from various different sources. Now we have to look at is what are the continuing expenses? What are those? What are those continuing expenses? In other words, what does it cost us to maintain our household and everything? What is it that's involved here? And so basically now you're saying, well, it's $110,000 is what we need to keep our family going, basically, for whatever reasons. We've got $110,000. Again, on the exam, they'll tell you how much income is actually coming in. They'll tell you what the expenses are. Okay, they have to tell you these kind of numbers. Okay, so therefore, what you have to do now is say, well, how do I fit all this into the formula? So if we have a continuing income of $60,000. We have a continuing expense of $110,000. Well, guess what? We have a shortfall of $50,000. In other words, we're short $50,000. So once again, now we have to take that $50,000. Okay, how do we create a pool that will generate an income of $50,000 a year? Well, it goes back to that capitalization of income we were just talking about. That $50,000, again, divided by a real interest rate. Remember now, real interest rate of 5%, we need $1 million worth of insurance, okay, in order to take care of that situation. So insurance need number one, last expenses, we needed $400,000. Insurance need number two happens to be the continuing income. So number two is $1 million. So it's $1 million plus the $400,000. What your client now needs is $1,400,000 worth of insurance. And that's basically what it is. So let me very quickly summarize this so make sure that we understand exactly what's going on. In capital retention, we have 4 key things that we must know. We must know what the assets are upon the person dying. In our example, we got $50,000. In our expenses, okay, we have $450,000, so we have a shortfall of $400,000. So we need to insure that $400,000. Okay, now we look at continuing income. Remember that client is dead. We've taken care of that over here, okay? Now the next thing we have to look at is the continuing income and continuing expenses. The continuing income is $60,000. Continuing expenses are $110,000. So we've got a $50,000 shortfall between these two. In other words, it's a negative. We have to capitalize that $50,000. So we divide it by the real interest rate, so 5% of the $50,000. It's $1 million worth of insurance just to keep this part of the family going, basically. So now you have $1 million plus your $400,000. So the total amount of insurance now that you have to insure your client for is $1,400,000.